Hey everyone, this is Robert Keens with goldsilverpros.com. It is Sunday, November 29th, 2020. This is our first report after Thanksgiving. Hope you guys had a great long weekend. I did. I took a few days off and spent it with the family, caught up on some shows that I wanted to watch, and had a generally relaxing time. And have to do that during these times because not a whole lot of great news in 2020. So the holidays is serving as a respite for me, as I'm sure it is for a lot of you. Today's video, we're going to be talking about gold and silver, of course, and we're going to be previewing what we think may happen in December. We've got some early numbers on the December deliveries on the COMEX in terms of physical deliveries. And we're also going to talk about where the money is going in the market. It's definitely not going into gold and silver right now, but we do have indicators of where it's going, and it's not necessarily the cryptocurrencies, it's somewhere else, and I'll show you that here in a moment. Before we get started, I want to let you know that the video is sponsored by Nevada King. Victory Metals and Nevada King have announced a business combination, or a merger essentially, into one big company that will give them over 5,000 claims in Nevada, which is the premier district mining in the United States, contributing 5% to the overall global gold production for the year and 78% of the US's gold production. You can trade Nevada King by trading, or you can trade the new entity by trading right now on the TSX, VMX for Victory Metals, and eventually the company will be renamed to Nevada King, and the name change on the exchange where you can find your shares. All right, getting into gold first, we're going to look at the long-term chart, and I've talked about this since July, nothing new here. We're having a little handle formation come, and the cup and handle that I've been talking about for a long time. Will we fill it back down to the $1,600 to $1,700 range to fill out this handle? Honestly, I don't really know. But we're going to see what's going to happen. I think the gold price really can go anywhere because it's controlled by the paper market and not by the physical market. We've had strong physical demand, which I'll show you here in a moment. We've also had strong shorts on the paper market to bring gold price down. And let's look at the short-term chart and see what we can see. You can see that we have broke the 2-year trend, which is this green line I drew since late 2018, since we had the stock market correction and gold started going up. Broken through that trend, broken through the 50 and 200-day moving average very strongly to the downside. You can see we've had more down days than we've had up days. Of course, this slaughtering on November 9th using paper futures contracts of gold. And then some additional follow-up toward the end of the month. And I've stated that's because I think certain entities are going to want to take gold cheaply off of the COMEX, get it out of the warehouse, and they're going to stand for delivery on their longs. And so they had to have other entities, namely the bullion banks, short the heck out of it to bring the price down. And we'll show you who's going to be doing that by looking at the commitment at traders report here in just a moment. But that's what's happened to gold. We've broken all trend lines to the south, so I don't see anything stopping this right now. I do think that we benefited from some uncertainty in the election, but now that period of time is over, at least in terms of where it stands in investors' minds. So I think are believing the story that Biden's going to get elected. We're now looking at a sell-off in gold, which is not abnormal for this market. We had almost 2 straight years of very strong price action to the upside, and technicals indicated that we would have some sort of pullback, and we'll monitor and see how far that pullback is going to go. We had a pretty good amount of volume on November 27th, and it was mostly to the short side, and I'm going to show you that here in a moment. Before we do that, we're going to look at where things are trading. I now think that February has taken over as the leading month in terms of gold price determination. It's no longer December. We only have 31,000 contracts of open interest right now for the December contract, almost 400,000 for February, 400,000. And we're still a couple of 3 months out from February. And February, I don't think is traditionally as seen as big of a month for the COMEX in gold, but it definitely is now. So that attention has shifted to February, April, and June to some extent. December is no longer a large month in terms of futures trading or in terms of open interest. And what that means is they're using the February contract month to determine the price, and we'll show you that in the settlements. We're going to go over here to settlements, and you're going to see where the gold price, if we go to the chart, gold price closed at 1788.10. If we can see this number right here at the top of the chart, 1788.10. And what did the price close in the February futures market on the last day of trading, Friday, November 27th? Exactly 1788.10. So that is a match for match, meaning that February is now determining the gold price, because as more contracts traded, it's near enough term that that's going to determine what the gold price is, unless a lot of people come into the December contract. There's a fair amount of trading here on Friday, 71,000 contracts, but the vast majority is here in February, and that's what's calling the shots on the price. Now we're going to talk about the COT report for gold. I want to look at who is going to be taking delivery using their longs for the month. And the longest entity on the market right now is this yellow category right here, as you can see by this line. They are the other reportables, and right now they're long 160,000 contracts of 100 ounce gold. The next would be the managed money, which is a financial types, although they typically don't stand for delivery. They're just price speculating, so we don't expect them to take a lot. The biggest shorts are the swap dealers, which are the bullion banks, 197,000 to the downside or to the short. And the next would be the producers. Now, the producers being short makes sense because they're hedging future the price falling risk between the time that they are planning their expenditures and getting gold out of the ground and the few months it takes to actually process, refine that, and get the gold to market. So producers make sense for them to be negative 97,000 contracts. The bullion banks being short 197,000 contracts, I believe, is just to bring the price down so that the other reportables, which are the wealthy individuals, the family offices, the trusts, and all of those people, basically the elites or their businesses in society, can take physical delivery on the market. And that's why they're record long, dating back quite some time, dating back at least 2 years. They're longer now than they ever have been. I think that's because they're taking gold off of the market. I wanted to give you a quick note on gold before we go to silver. There was an article out here in Reuters on November 23rd that JP Morgan dominates the gold market with a record $1 billion in precious metals revenue. It says here JP Morgan has earned record revenue of around $1 billion so far this year, that's 2020. Storing and financing precious metals vastly outperforming rival banks, two sources familiar with the matter told Reuters. Now, JP Morgan is one of the aforementioned bullion banks who are shorting the market, and they're making $1 billion shorting the market and storing the metal. So they make money on the physical metal movement as well as the shorting of the market. Now, as you recall, as I reported in a video back, I want to say several weeks ago, we reported that JP Morgan was fined $920 million for rigging both the COMEX markets and the treasury markets. And that's really a drop in the bucket for them, as we can see, because on just the gold market itself, and that's certainly not the only futures market that they trade in, but just in the gold market, they made more than that entire fine. And that fine was levied for past behavior. So the question is, how much do they make in the treasury market and the commodities markets? It's at least $1 billion in gold. How much do they make all of those combined minus what they paid a single time fine? You can see why it's so profitable for JP Morgan and other bullion banks to manipulate the market with record short positions, such as in gold and silver, mostly in gold, but also in silver and other futures like coffee and things like that, because they make more on the trades, storing it and facilitating the movement of the actual goods on the exchange as well. So again, drop in the bucket, the $920 million fine for JP Morgan, and it's business as usual as they continue shorting as one of the bullion banks. They definitely have not stopped and closed their trading desks. They're still doing it. So as we see in silver, basically the same thing. We've got a downtrend since late July, early August in silver. That's a nice pullback. Of course, we had a very healthy run. It was almost a straight line upward. It doesn't surprise me that it's pulled back some. I still think that silver price should be higher if we're actually relying on physical supply and demand, because we've had a shortage in terms, and I've showed this chart many, many times from Reuters and Bloomberg and other major financial outlets, where we've had a shortage of silver produced according to what's demanded every year. So we're using more physical than we're producing. We've drawn down a lot of stockpiles. Nobody knows what the final stockpile is out there, but we know that in the United States, at least, we definitely have supply shortages as reported by U.S. Geological Service. So why isn't silver price higher? Well, it isn't higher because of all the shorting. You see the red here. All the shorting has brought it down below the 50-day moving average. We're below critical support levels of the 2450. In fact, we'll go back out to the long-term chart and we'll see how many critical support levels we've blown through since the summertime. We've blown through the almost $27 range, the 2450 range. And it looks like we're coming up against $22 support here. If it blows down through $22 support, the next support line is about 19. So if you see silver fall through $22 this month, you could expect maybe to get down to $19 silver. Before this is exhausted, of course, I think the pent-up demand may eventually drive that up. And I think the demand from manufacturers who need silver may eventually drive that up. But it looks like this year we're going to continue to trend down in silver. And of course, you look at the trading on November 27th, we had 116,000 contracts traded. And you can see now that the majority of that's trading in March. So March is now determining the price for silver, and it traded down to 22.63. If you look at what it closed, it was 22.64. So the close, the last trading day on the 27th, was $22.64. And you can see that on the February contract, it was basically 22.64. 22.639 is round up to 22.64. If you add 1/100th of a data point to that. So it is clearly the March contract that is determining the silver price and not December. We only have 18,000 trading on the December contract for November 27th, whereas we have 95,000 trading for the March contract. Similar to gold, which is trading heavily in February. And now we have 123,000 open interest in silver for March and only 9,400 for silver in December. What I basically think that means is they brought the price down enough in gold and silver that they're able to take the physical delivery off the market that they want. And so they don't care the rest of the month if the price rises. They've got it down in time for delivery day. And we're going to show you that here in a moment. Before we do that, I'm going to show you the COT report, which is Commitment of Trader, which is published by the CFTC on a week delay. That's key to note here. The people that are the most long are the managed money. They're speculating that silver is going to go up, and they've taken positions for various financial interests in the industry. They don't typically take delivery. The other reportables, so wealthy individuals, are net basically break even right now. I think they are, well, 2,000 contracts along a 5,000 ounce silver. Maybe they want to take a little bit of delivery, but not a whole lot. And then, of course, you have the swap dealers are short. That's to keep the price down, as we stated many, many times, the bullion banks, because the producers, this red line, have their own position, and they are very, very short. They're the shortest they've been since about March, when we started having the issues with the shutdowns. So the producers don't need the bullion banks to take that position short for them. The bullion banks are doing it short the market and bring the price down. It's pretty obvious by looking at the data. I wanted to go to the actual delivery notices. We're going to look at November delivery notices. We had a spike up in gold delivery at the end of November. We've also got the first day of December delivery, notice of intent delivery for the COMEX as well, which is a key to showing how much physical delivery there's going to be for December in both gold and silver. So we'll start off with the November data, the COMEX gold futures. I want you to notice something. Back here on the 19th, we had 5,953 contracts, and it looked like the daily total of deliveries had fallen to about 122.91 a day, less than 100 a day on average for about 4 straight days. Then something happened the last 4 trading days of the month. On the 20th, you had 1,800 contracts stand for delivery. The 23rd, you had 769 contracts. Then 24th, you had 1,043. The 25th, 1,503. So leading up to Thanksgiving, you almost doubled the amount in 4 days of gold that would be delivered on the COMEX in 4 days. And I believe that's because people know that there's going to be a massive amount of deliveries coming in December, as I've been calling now for about 5 to 6 months. And so the people that are getting in early at the end of the November month to try to take as much delivery as they can. Now, the reason the price didn't rise is because of all the shorting, which I showed you based here on the futures chart. If you look at the volume, there's massive interest to, the settlements. There's massive interest to the downside. You see the futures contracts trading below what was the price, which is pulling the price down, why they were able to take physical delivery these 4 days off the market. This day, this day, this day, and this day. And they're able to almost double in 4 days what was done all in November in 4 days while they're shorting the price of the futures to get gold off of the market very, very cheaply. And what's really interesting as we get into silver, the silver futures, we did not have the same thing. I don't think there's a run on silver on the COMEX right now. Here's the silver futures right here. You had most of it occur at the beginning of the month and a little bit in the middle of the month, and then basically none at the end of the month. And so silver, basically people had gotten what they already wanted off of the COMEX service, source of silver that they needed. We're going to go to the December numbers. Here is the gold futures number. The very first December intent delivery date, remember 2 business days before the first calendar day of the month, you can notice your intent to take physical delivery of the metals on the market. In other words, you can get in a couple of business days early to say, hey, I want to take delivery, because it takes a couple of 3 days for the actual delivery process to work out. So you can start a couple of days ahead of time, say, hey, I want to take delivery, and by the 1st or 2nd of the month, actually take a physical delivery on the COMEX through the vaults. 5,371 in a single day. So I think this is telling us that December is going to be a really big delivery month for gold. And I think the bullion banks will continue to short so they can get the gold off of the exchange very cheaply. Of course, they've taken it down from almost $2,100. I think it got up to like 2070, all the way down to about 1788 in anticipation of this December delivery, and as well November. They took it down so they could get delivery in November as well. And if you look at the COMEX silver futures, they did the same thing in silver. Lots of delivery on the 1st and 10th date for December, 1,169 contracts of 5,000 ounce silver taken off of the exchange. I think we'll continue to see a lot of silver taken off as well. And it's interesting to note that they've already shorted it down. They only need a certain amount of contracts to keep that price shorted for December while they take delivery, but they're now using February in gold, and in silver, we'll get back to the settlements, they're using March to keep the price down. That's the interesting thing about the futures. You use a future month to keep the price down, and you take physical delivery that month. Of course, that's why it's called a future. So that's basically what's going on. And silver, no surprises there at all. I did think the open interest was going to stay stronger in December for both metals, but I guess if you can hammer the price down using the February March contract, you don't need to keep all that open interest in December, and that's allowing them to get the metal off the market very cheaply. Now, I did tease at the beginning of the video, where's all the money going if it's not into gold and silver? Well, obviously in the futures market, it's not going to gold and silver. There's a lot of shorting going on. Well, where is the money going in this uncertain market? A lot of people say Bitcoin, the cryptocurrencies. I agree, but those are really small markets. Remember, the gold market is an $11 trillion market at $1,800 gold. This is something I showed to you in my last video earlier this week, or last week, if you will. And the Bitcoin market is something like a $350 billion market. And some of the other altcoins are 100 billion or less. So those are tiny microscopic markets compared to the precious metals markets. So this narrative that people are going into the Bitcoins, Ethereums, and Litecoins and XRPs of the world, Moneros, as a replacement for investment in gold, silver is offset by two data points. One, there's massive deliveries in gold and silver on the COMEX. So yes, people are still buying gold and silver that's getting at a discount price. And two, the gold and silver markets are much, much bigger. So if you really took trillions of dollars of value out of the gold market and shifted it over to Bitcoin, I mean, you may be looking at a $1 million price for Bitcoin. Obviously, that's not happening. So most of the volume of safety is not going from gold into Bitcoin. I'm going to show you it's actually going to the stock market. And these are hard numbers. And there's actually an indicator I'm going to use to show you this first. And then I'm going to show you the record inflows we've had to the equity markets based on some data from Bank of America. And this will go to prove my point. So here at CNN Business, they have something called the Fear and Greed Index. And it's basically determined by these things down here. Put and call options. A put is basically a short, and a call is a long, essentially, in an option format. I'm not going to go into details, but if you have more puts, you're going short. If you're going more calls, you expect to go long, or you're bullish. Puts are basically bearish. You have safe haven demand. It's the amount of stocks versus bonds. When that ratio gets really high, it means people are putting a lot more into stocks, more risk, less into bonds, less safe haven. That's safe haven demand. They also measure stock price strength, stock price breadth, market momentum, junk bond demand. Junk bond is high interest rate bonds, very risky bonds. People go into those when they're feeling greedy and less fearful. And then also market volatility is a measure of how much volatility the market expects to have. Of course, that number's been low. They're not expecting a lot. So notice what happened. Going into 2020, people feel really good. You almost had 100 or extreme greed on the chart. And then we had the shutdowns. And then gradually it's come back up to almost 100 where it was a year ago. So it's basically an analog of where it was before we had the shutdowns. And you look, we're sitting at 92 out of 100 on extreme greed. So that tells you people are going into the equity markets. They're eschewing bonds, eschewing to some extent gold and silver, and that all that money's not going into Bitcoins and cryptos, as I'll show you here. This chart in an article from Zero Hedge is basically sourced from Bank of America and EPFR Global, and it shows record inflow into global stocks. So in billions of dollars, almost $100 billion. And so it's the highest point it's ever been since they've been measuring this since 2005. In January 2018, this measure got almost to about a 90 count. It's almost to 100 count. So record 3-week inflow into global stocks lately. And the global stock market is a lot bigger than the crypto market. So that narrative that people are choosing Bitcoin, Ethereum, Litecoin over gold and silver is wrong. They're choosing stocks and equities, as shown both by the Fear and Greed Index and also by the record inflows into global equities. That's where people are putting their money. Now, I'm not disparaging the cryptos. Yes, they're getting bid up for reasons in which I talked about in my last video, but I think it's more for institutional reasons than retail reasons, meaning I don't think it's all the retail investors bidding up the cryptos. I think institutions are doing it because cryptocurrencies are the currency of the future, and they're making their bets on various cryptocurrencies, trying to legitimize that market because I think they see the death of the dollar coming, and that's something we talked about on our videos many, many times in the past. One last thing I wanted to share with you guys before I wrap it up, another article here on Zero Hedge. Thank you for all that you do, Zero Hedge. Lots of information. Here's a study from Bloomberg showing that we may be headed into a dark winter. I'm going to read some text from this article and show you what's going on with potential bankruptcies and evictions and things like that. It says here, a dark COVID winter is descending on the working poor of America as millions of adults face eviction or foreclosure in the next few months. Bloomberg, citing a survey that was conducted on November 9th by the US Census Bureau, shows 5.8 million adults face eviction or foreclosure come January 1. That would be in about a month. That accounts for 32.5%, or about a third, of the 17.8 million adults currently behind on their rent and mortgage payments. And you can see a nice chart here of the worst areas. The ones that are light blue are the ones that are least affected by this. The ones that are red are the most affected, and sort of the black or gray is about in the middle. So you can see that a lot of areas, a lot of heavily populated areas, including California, Florida, the New York and East Coast area, and some of the heartland as well, the flyover states, are really affected by this situation. And it goes on, the article goes on to state that they noted that on December 31st, many of the key provisions of the CARES Act are set to expire if there's no action from Congress. And what this does is it'd be catastrophic for 12 million Americans who will lose their access to emergency unemployment benefits activated in the aftermath of the pandemic, which alone could be a drag of up to 1.5% of growth in 1Q. And it goes on to point out that at least half of households in Arkansas, Florida, and Nevada are not current on rent and mortgage payments. And you can see the housing dilemma here. It's highest in New York City, Houston, Los Angeles, Atlanta, Phoenix, a lot of these metro areas. So essentially, this is a double whammy. People are behind on their payments by somewhere between 3 and 6 months. That means on January 1st, they can either be evicted, or in many of these states or locales, or they could be foreclosed upon if they own a home, a massive amount, up to a third of 17.8 million of adults who are behind on their payments, which is about almost 6 million adults face eviction or foreclosure. Not only that, but some of the provisions, and I talked about this last week, the Fed and the Treasury arguing about some of the provisions and the money, a lot of this money that could have staved off this foreclosure and eviction for people and also allowed them to buy food is maybe not going to be re-enabled from Congress. And they've only got a month basically to continue those funds, to elect to continue those funds, or else a lot of these people face foreclosure. Now the question will be, will all the landlords kick the people out? And will the banks basically evict the people who hold those delinquent mortgages? And if they do, what's going to happen to the economy? I think this is very serious headwinds in the economy leading up to 2021, as I've stated many, many times. We'll go ahead and get off the screen share here. And I think what that means is people don't have money. Now, there have been a lot of long lines you've seen on Twitter and a lot of social media, people in North Texas and New York and many other places lining up for the food banks in record amounts, absolutely record amounts, because they don't have enough money to buy food. And we can see from the chart from Bank of America that they don't have enough to pay their rent. And unless they get assistance from the government, they're basically screwed. So a lot of people are really hurting, and we're starting to have this two-tier society where more and more people are getting into the working or non-working poor, and less people can afford to live and to eat. And as people seek safe haven investments, they're basically going for the home run in the stock market and in junk bonds, as we showed you from that previous Zero Hedge article as well, because they've got to get return. If they don't get return, they could lose their house. They won't be able to eat. So this is, I think, desperate times. And I think this is why you want to hold gold and silver. And for those of you cryptocurrency guys out there, yes, there is some investment in cryptocurrencies. I think it's more institutional funds, because if you really saw the difference, if you saw people coming out of the gold market and into cryptocurrencies, the prices and the indexes would be much, much higher. And we saw that it's not. It's really in the stock market. People going for the home run. They're not going over to as much to Bitcoin, Ethereum, Litecoin, Monero, XRP as you may think, although there is some going there. A lot of it's going to those home runs in the market economy, so that people can basically make ends meet. And this I think is a last gasp measure for a lot of people who cannot afford to live, trying to get those home runs in the market, trying to maintain return. And come January, February timeframe, it could look very, very ugly. So regardless of what you see going on in the futures market with all the shorting on the gold and silver price, I think this is another reason long-term why you want to be in gold and silver, because they've held their value for so long. They're recognized safe haven assets. Regardless of what's going on in the shorting, they're going to maintain their value. They're still less volatile than the crypto index or the treasuries, and bonds right now are not returning anything. So why would you go into bonds? So I think gold and silver are still the most obvious places to put your money. If you want to be highly speculative and deal with the beta of the crypto market, you can go into cryptos. Right now, it looks like people are going into stocks, and it looks like desperation to me on the greed index, as we showed. I don't see good things going in 2021 first quarter. Of course, this is something we'll talk about in the first quarter's newsletter. When we publish this in January, we're going to do a State of the Union for 2020 and a preview of 2021. Those of you interested can go to the website and sign up for that. Definitely some rocky times ahead. So I'm not worried about the future shorting in gold and silver. It's done to get the physical metal off the exchange. Whenever they run out of the physical metal, whenever that is, we don't know because I don't trust the inventory numbers because there isn't formal published audits. There's audit, but not formally published, and they're very sketchy and questionable. We don't know how much is gold and silver is actually available on the exchanges. Plus, the CME Group's admission that I covered this earlier in past months that they don't even know about the eligible gold inventories and how much is long-term investment versus how much is liquid for the exchange. We don't know how much is gold and silver is there, but eventually it's going to run out. You see the scheme. They're shorting to bring the price down right towards the end of the month. Then they start to take massive deliveries, and then they roll those open interest positions into the next big trading month, and they do it over and over again. They're obviously liquidating the gold and silver off of the market. Most of it's going to eligible, not registered, so it's not eligible for futures contract delivery. We've shown that chart from Nick Laird's site before, how this has been going on since 2000. It's very clear that there are more razor thin margins in gold and silver on the exchanges. So if you want your gold and silver, go get that gold and silver now, because I don't know if you're going to be able to get it 6 months, a year, 2 years from now. It certainly looks like the wealthy individuals are trying to get it off the market as quickly as possible, as we saw in the data. Last bit, if you guys are interested in gold and silver, but you're not sure where to store it, we do have an affiliation with Glint. Glint is a firm that provides gold storage at Brinks, which is a world-class gold storage company. It's considered the strongest gold storage company in the world. They're also insured by Lloyd's of London. If you're interested in getting that gold stored there and having a debit card that you can use to liquidate that gold at any time and convert it to liquid cash, or to convert it to a purchase when you need it, you can go to glint.com/gold silver pros, or you can download the app from the app stores and use the referral link gold silver pros. And that will help me out a little bit and bring a little bit of funds into our pocket, so we can continue to bring you all of this wonderful research that we do. Till next time, guys, that is Robert Keens with goldsilverpros.com.